All right, welcome everybody to the June edition of the Challenge Club. My name is Mark Robertson. I'm joined here by Lori Fredrickson from Vivio, and we have a whole bunch of very recognized names, many club members here. Looks like a few guests. We'd like to give a extra special shout out to anybody that may be joining us for the first time, and again, a very special welcome. Again, we do encourage participation by anybody in the room, in the audience. You can do that by either raising your hand and going live on audio. We do have to, because of the size of the number of attendees, everybody does start the meeting muted, and we have to unmute you to actually allow you to use any microphone hardware that you've got. If you don't have a microphone, you can submit a question or a comment by using the questions tab on your right-hand control panel. So all those things are available to you. The other thing that I like to point out is that fairly frequently we actually scan the questions that are in the questions log, and we'll often post responses to those questions even if we don't get to them during the session. We do try to generally make the session about an hour long or so. So let's go ahead and get underway. Again, this is the June session of the Challenge Club. We'll get a little bit of the housekeeping out of the way first. We are going to talk about real companies in real time, express opinions and judgments. This is all about the demonstration of a technique that many of us know as an approach to analyzing stocks and managing portfolios as promulgated by the modern investment club movement. And the key takeaway here is that no investment recommendation is intended whatsoever. We demand, we insist that we all do our own homework. This is the basic agenda, kind of our standing agenda for these meetings, and this is a standing agenda that goes literally back to nearly 1999. Just kind of some opening remarks. We'll take a look at the performance of the portfolio for a minute or two. We may challenge a stock within the portfolio, and the floor is wide open for nominations for either selling or buying. We like to take them kind of one at a time. So we kind of go through any potential selling candidates first, follow them with purchase candidates. And if you are particularly new here, please know that you are welcome to participate. Everybody here gets a vote when we go to a vote, and we welcome any participation, either be by input or comment or by voting. And then generally we may have a little bit of time left over tonight. We can basically take a look at anything that anybody wants to. This particular group of investors does have a participating entry in our annual stock picking contest known as the Groundhog, and you can find it under Challenge Club Select. The last time I checked, I'm always afraid to look. I think it was doing fairly well the last time I actually paid any attention to it. So those are the type of things that we'll cover. Just a little bit of background on the club. It has been around literally since 1997 in a variety of formats and venues. We did switch to kind of an emulation, which is kind of a weak simulation of an investment club back in September 1999. And now it literally is just kind of a group effort, a very casual effort, but I would say committed effort to take care of the actual club portfolio. And actually have done pretty well over the years, and we want to keep continuing down that path. Starting in January of 2010, we did bring the portfolio to Vivio for record-keeping purposes. Thank you, Lori. And we have been keeping track at Vivio, and we do feature as part of every single meeting. And by the way, I think this is an awesome practice for any investment club, just to get a handle on how well you're doing. Your report card is your performance benchmark. Now, we use the performance benchmark at Vivio. We can only use it since January 2010. Since that point in time, we've achieved a return of 4.1% that you can see here on the slide. Don't panic. That is just a couple years of performance. And this 4.1 that you see here stacks up versus 8.1% if it had been invested in the S&P 500 index fund. So we literally do have a negative 4% return. That has been a little bit weaker than that. We've actually had a pretty good year to date so far. In fact, we are 1 percentage point ahead, beating the market S&P 500 year to date. So we actually are doing pretty well in 2012. And then even more importantly, if you go all the way back to September 1999 and you basically take a look at the club unit value and do an annualized return, you actually end up with an annualized relative return of positive 4%, and that's just simply outstanding. Here's a look at that relative return over time. I think I skipped over a slide. Let's actually come back here just to give you a feel for, we know better than to expect outperformance every single year. There are quite a few years where the performance of the club did beat the market as measured by the S&P 500. Even in the nasty years that are shown here, this drop in performance still outperformed the market by a fairly significant margin. 2009 was very, very good to the Challenge Club. 2010 wasn't bad either. This is that first year after we started keeping score. Took a little bit of a hit there. But again, you can see not every year do we outperform the market, but there's enough outperformance to be actually fairly special when putting it into the context of very long-term results. Here's what that looks like as a progression, a time series progression over time. You can see that we are settling in somewhere, at least lately, around that 4 to 5% relative return after a few glory days back at the beginning of the first part of the last decade. Here's a little bit more context. It's a slide that many of you have seen several times over, so I'm not going to spend a lot of time on it other than to point out that the Challenge Club is somewhere in this range. That blue dot could be the Challenge Club. The red dots are the institutional portfolios that we have mapped. The blue dots, including the light blue dots, are basically club-influenced portfolios. They're either portfolios or actual club portfolios. And we notice that there's a fair number of blue portfolios on the top half of this graph. Again, anything above that dotted line is a club or a portfolio that's outperforming the market by our target. You can see a whole bunch of them here. And one of the top performing institutional of all time is Peter Lynch and the Fidelity Magellan Mutual Fund, plus 13% over 13 years. Another one that I actually was a member of, Mutual Club of Detroit, actually outperformed the market by about 3 percentage points over 60 years, from 1941 through 2001. And of course, that infamous investor, Mr. Buffett, out there in Omaha, also has an exceptional track record covering 46 years. So again, you want to place it in context. If you achieve anywhere in this range, we think you're doing pretty well. And again, if I went out and grabbed another 100 institutional portfolios, most of them would end up probably clustered fairly tightly down in this area of the graphic. We'll be doing that. And again, I expect most of the added institutional funds, most of them will end up in this area of the graph. So again, context is important. 5% is special. Notice how few of the dots are above 5% relative return, especially over the long term. So with that, let's go ahead and switch to the portfolio. Take a look at a mini dashboard, basically condensed down to take a look at the 3 major characteristics of return forecast, which is actually pretty good for the portfolio, 16.6, with the median projected return for all stocks at 9.6. We basically want to be somewhere in that 14 to 19% range. That's what this arrow is all about, and this portfolio is. So we consider the portfolio to be fairly well positioned. Quality is just fine too, maybe even a little bit strong. We could afford maybe a couple smaller stocks that have a little more friskiness to them, and this is just fine also. We're definitely in the range that basically serves to protect us from deep corrections in bear markets. And last but not least, we do have a mix of faster growing companies and slower growing companies that support an overall average sales growth forecast of 11 to 12%. And again, our advice that we've gleaned from watching successful investors over decades is that you want to be somewhere in that 11% plus or minus a percent or two, depending on who you are, for the overall sales growth forecast for the overall portfolio. All 3 of these numbers are weighted averages. So in the case of our portfolio, Apple is the strongest influence on any of that because it's 13.6% of total assets. Are there any questions or anything at this point, Lori?
John Kimmel had quite a few things. He mentioned that he was interested in the charts for Cognizant. SLB, I think, is Schlumberger, isn't it?
Yes.
QSII and Cisco, because they might look attractive for tonight. And he was mentioning maybe you could challenge Colgate-Palmolive.
No,
and then
you know that's not allowed here.
Marty was asking about comparing, I think, relative return to VAY. Is it the value line?
Yeah, that's the value line arithmetic average. We can take a look at something like that, sure. Okay. We'll actually end up progressing through some of those stocks that John has mentioned, and I know John probably has a microphone unless he's away from the computer that does have it, so we can perhaps engage John in some of the discussion of some of those specific holdings here in a few minutes. And I'm serious, Colgate-Palmolive is my dad's favorite stock, so we're not allowed to talk about it. We're going to talk about something.
Walgreens was your dad's favorite stock.
Oh, no. No, Colgate's his favorite. Walgreens is one of his great tormentors.
Oh, okay.
Walgreens and General Electric. All right, enough about my dad. Let's go ahead and wrap up the portfolio, and then we'll overview, and we'll kick into a look at the portfolio. Here's the size diversification or the growth diversification for the portfolio. You can see that it's pretty well diversified amongst the smaller, faster-growing companies. Maybe a little bit of an emphasis on the smaller ones that might be a little bit heavy, maybe a little bit light on the larger companies, but not bad. The key point to take away from that is it's split up three ways, and we don't have any one of them dominating the other two. Here's a quick look at the sector diversification, and again, this is actually pretty good. Those of you that have been around for a while know that our technology concentration actually drifted up into the 40% or even higher range there for a while. And we have been able to find opportunities in enough different areas that technology and healthcare have kind of shrunk back a little bit. The one takeaway that I would have if this were real money and I was taking care of it for myself is I would just be really reluctant to shop for opportunities in technology or healthcare unless they were really special, is what it would really come down to. They'd have to be really special for me to want to go there. Otherwise, I would, without obsessing over it, try to find opportunities in some of these slices of the pie up at this end of the chart. Okay? So with that, let's actually dig into the overall portfolio. This is actually a look at the overall dashboard, top to bottom. You can see it is arranged by percent of total assets. So the largest holdings are at the top, smallest at the bottom. You can see going into tonight's meeting, we have approximately 2% in cash. So that's what you want to think about for any potential purchasing motions. And really, there's nothing that jumps off this page that's incredibly weak or substantial. The 13.6, even that is, it's high, but it's not too high, not too far out of bounds. And it's basically pretty well diversified or distributed amongst the number of stocks that we have in there. We do kind of have an artificial limit at 20 stocks for the portfolio. Our rule of thumb is 16 plus or minus 4, so we wouldn't want to drop down below 12. We'd really be reluctant to go above 20, but you can see that there actually would be room to, I'm not even sure how many are there. Looks like there's about 18 or 19 there, so we could actually look at the possibility of adding to the portfolio if people were so inclined. As many of you know, we do like to take the holdings and sort them by their projected annual return. That's the column on the far right, so that we can isolate opportunities from strongest opportunities, even those that would be deemed speculative, down to the opportunities that have that are the least robust in terms of the return forecast. So in this case, the weakest return forecast is from an excellent quality company. Look at these financial strength ratings, earnings stability ratings, and quality ratings. This is obviously a very high quality company, but it does have a projected annual return of approximately 8%, based on the assumptions that are displayed here. But again, 8% is not that far from the median in the market, which is approximately 9.5. So again, it's not anywhere near money market rates, and it's not terribly far from an average market stock. And we don't have any core stocks that are down around money market rates. We don't have any non-core stocks that are around the market projected return. So there really is not any tremendous weaknesses in here in terms of any direct selling opportunities. That's my opinion. Other people may have others. Now, the floor is open if people want to recommend a selling motion on any of the stocks here, especially if you know of any really adverse stuff, the kind of stuff that Lori comes up with when she delves into these companies' accounting statements. But other than that, pretty good from top to bottom. I am going to share one thing with you guys tonight that I have been doing, and I have been doing for the last 6 months or so, trying to figure out what it means to us. And when I say what it means to us, I mean all of us. And I mean in terms of keeping it simple and offering the potential of generating incremental returns. I still don't know the answer. So we're still asking the question, but it has to do with this next slide. All I've done here is taken the portfolio dashboard, again, sorting it from top to bottom, from highest return forecast to the lowest or weakest return forecast. And now what I've done is actually superimposed over the top these two trends. And these are technical trends from technical analysis of the stock using the point and figure techniques that you can use at stockcharts.com. We can take a closer look if anybody wants to. But what I've actually done is showed the stocks which are deemed bearish. Bearish, which basically means the institutional investors are disinterested or angry or something at some of the stocks, and they're basically, for whatever reason, and for an indefinite trend, putting downward pressure on some of these stocks. You can see Cognizant here. In fact, I believe Cognizant, somebody was talking a few minutes ago about Cognizant being downgraded by Goldman, and they think it's piling on at this point. So the bearish ones are actually redded out. The ones that are neutral, and they basically could go either way, bullish or bearish, are in yellow. And again, what that allows us to do is, again, come down into the sweet spot and actually do some shopping for companies that are still in the sweet spot that actually have, if it doesn't have a yellow or red, it's actually bullish. So companies that are in the sweet spot that perhaps do not have too high of a concentration, and I just throw out there as food for thought, companies like Stantec, Microsoft. You know, we might be reluctant to add to our position in BioReference Labs because this is a little larger than the average position. So again, of the ones that kind of jump off the page a little bit, it would be under using this approach, Microsoft and Stantec. So let's go ahead and open up the floor for questions and observations or motions from anybody out there.
There's a variety of things here, Mark. I don't know if this is a motion. John Kimmel was saying maybe just sell 50 shares of Clorox, or Colgate-Palmolive, I'm sorry. Mary Wrench mentioned Gentex as a possible different stock, and Marty recommended maybe looking at FOSL.
Okay.
Or EXPD. And then Butch Lang was asking whether there was any updates on QSII.
Okay, we got a lot of stuff to look at. Well, let's go ahead and start with. Let's check and see if John Kimmel's got a microphone.
No, he doesn't.
Okay, he did last night, so he must be in a different location today.
Yeah.
I guess the thing we could do is, I mean, he wanted to talk about many of these stocks, including Schlumberger. He also mentioned QSII. Butch Lang mentioned QSII. I guess let's open the floor for. Why don't people just identify either with the questions tab or by raising their hand which company they'd want to start with, and see if we can't get something to a formal motion. Since while we're thinking about that, John did mention the possibility of a motion selling 50 shares of Colgate. So let's go ahead and consider that an actual formal motion using a challenge approach, basically. Basically going through the motions of challenging the lowest return forecast stock within the portfolio. And if we get a second, we can actually take that to a little bit deeper discussion and take a closer look at the possibility of selling.
Butch has his hand up. Should I unmute him?
Yeah, go ahead.
Butch, did you want to talk about Colgate?
No, I was just commenting on QSII. And I've been following the threads and so forth on Manifest. And I'm just wondering if there's any other updates. A little bit of a selfish interest here. We have it in one of the clubs that I'm in, and actually we're considering making an additional purchase at the price points where it's currently at. But I haven't seen anything real negative on it, but I'm just wondering what other people out there have been seeing.
Okay, well, we could dig into that one. That's actually not in the portfolio. Well, it is. It is in the portfolio. It's actually regarded as neutral in terms of the overall trend.
You do have seconds to sell Colgate-Palmolive. Do you want to deal with that and then go to QSII?
That one first, because I want to see John go down in flames here, because I know that none of you will let me down and allow us to sell any of that Colgate position. I'm kidding. But in fact, it might be a good thing to try. Well, first of all, let's take a look at some of the basics behind it here. I'm going to jump and go to the value line report for Colgate. And again, you can see, and the price is actually down a little bit from where it was there, I believe. You know, value line has it as at least a low double-digit low total return forecast. So that's actually a fairly powerful condition. Let's go ahead and take a look at it over here to see what it looks like technically. And it's got a fairly good longer-term trend. Suffered a little bit during the Great Recession, going from left to right, but it's actually been fairly strong lately. It's right at $100 as of tonight's close, $100.10. It's basically kind of right in the middle, and it's also neutral with respect to the trend. So from a momentum standpoint, it's kind of neutral. From sentiment, it's also fairly neutral. Everything about the stock is basically fairly neutral. And it obviously looks pretty good on a stock selection guide too. Does anybody have any other comments? I know that Procter & Gamble has been getting beat up quite a bit in the press, and kind of some saber rattling going on there, in my opinion. But haven't heard.
They've been being beat up, but then part of the reason they're being beat up is because people are saying companies like Unilever, and I don't know about Colgate, but are in the same market and are doing better than Procter & Gamble at it. So that's why everybody's also going after Procter & Gamble. Procter & Gamble made a big push overseas and to get into new markets, and it's not panning out like they anticipated.
Right.
So they're kind of reassessing their strategy.
Yeah, and for years, those of you that have been at this for long enough, you will remember that Colgate-Palmolive really had some management convulsions back in the early 1990s. And for me as an investor, getting involved back in the early 1990s, it was kind of fascinating to watch the case study of Colgate-Palmolive talk about how they were going to restructure their corporate portfolio of products and put it all back together. And it was really, really neat to watch. It's one of the ultimate case studies of watching management tell you what you're going to do, what they're going to do, and then watching them go do it and execute on all the stuff they went out to do. And, you know, over these last several years, I think, especially with the Gillette infusion, I think Procter & Gamble's kind of in that mode. And I guess some people are expressing the opinion that they might not be executing quite as well. I'm just... That's my nutshell understanding of what Lori is talking about there too. But Colgate actually has done a pretty good job of implementing those particular strategies. Lori, I actually did add a couple of polls. I don't know, can you get to the polls tonight as an organizer? I might try. I actually did.
Actually, I can.
Why don't you take a look?
What? Yeah, I do see some polls. Which ones?
I've got one there that's like existing holding, and we can do buy, sell, or hold on it. You can probably take a look.
Do you want to? Okay, yeah.
Let's go ahead and
do you want to launch it, or?
Yeah, let's go ahead and call the question. This will be on Colgate-Palmolive, and the motion is to sell 50 shares of Colgate-Palmolive. And again, everybody here can go ahead and cast your vote. As I understand it, I'm not allowed to see it. I'm also not supposed to do any campaigning. And I'm not allowed to vote. I guess I'm just a lower life form around here. Does anybody feel sorry for me yet?
That's pretty exciting, too.
Can you see it? And I can't see it, and it's happening? I got to see if I can figure out how to see it. Oh, I can. I can actually view it in the pull-down window, Lori. So
all right.
So now you have to tell me the truth about what you're seeing.
Yeah, but you're not allowed to comment on what you're seeing.
Oh, I'm not? Okay. A lot of the people are participating in the vote, I see. And again, if we were to sell it, it would free up about 1.7% of total assets.
Looks like everybody's voted that's going to vote, so I'm going to just close it and share the results. So it's closed, but it doesn't look like, it looks like people would prefer to hold than to sell.
Okay, so 57% saying go ahead and keep holding it, and 43% people saying sell.
Yep.
And you'll be taken off the Robertson family Christmas card list. We have tried to sell this a couple times in the past. All right, so we'll close that one down. Colgate usually has to withstand that type of a challenge about once every 3 or 4 months, because it has been down amongst the lowest projected returns in the portfolio for a long time. And I hope everybody was noticing that chart that actually looks pretty good when it pops back up on your screen. That so far holding it hasn't been the worst idea for the Challenge Club portfolio. Any other motions we can actually take a look at? Butch wanted to take a look at quality systems. We can do that. Let's go ahead and run it through a couple of the things that we normally check. Here's a look at quality systems and some of the nastiness that has happened since the beginning of the year, actually going back to about Halloween of last year. Notice the right-hand side of this has a fairly significant drop in price. A technician would look at this and wonder if it now has not reached a point where it's oversold. In other words, too late to jump ship unless you have a really compelling reason for doing so, or you're witnessing some tremendous degradation in company fundamentals. And one of the ways that we check for that is to jump over to Yahoo Finance and just make sure it's not falling off the planet, off the cliff, when it comes to the analyst estimates for both revenues and earnings. And in this case, we see it did take a bit of a hit for the year ending March 13th, as is shown here, but it has kind of stabilized over the last month or so. And then it did also take that same hit for the year ending March 2014, but again, it's kind of stabilized over the last 30 days or so. So it did take a little bit of a hit, but it doesn't seem to be continuing to degrade, at least in that sense. You are talking about a company that is probably not going to grow at 20% so much anymore, probably down closer to the teens. Jumping over to Manifest and pulling it up from within the portfolio, just for a closer look at the assumptions that we have, you can see that again, this is analyst consensus influenced growth forecast of 13 to 14%. A little bit of a relaxation in margins, but still pretty robust at 18%, and still a fairly handsome PE ratio. So again, without any degradation in the overall fundamentals, any opportunity to have a fire sale, we should have been looking at selling back here if there was any intent to sell the company, in my opinion. I'm not aware of anything else. The floor is open. If anybody has any other observations or news on quality systems that we should bring, there is a pretty good thread going on the Manifest forum. And we certainly welcome any contributions there if somebody finds something unusual.
Which is wondering, since they have upcoming their first quarter earnings are coming out in July, would it make sense to have a trailing stop loss order? I looked at this one pretty closely because I have it too, and it seemed like they had way overreacted to what came out in the earnings. So though when I actually listened to the earnings conference call, it was a little bit less enthusiastic than I thought. There was quite a bit of, well, if this happens, then this will happen kind of stuff. Nothing alarming, and they're projecting 20% sales growth this coming year. They're projecting nice sales growth, and the only reason for the earnings hit was the closing, when they could actually recognize the revenue from a contract they were working on. I think it just made people nervous that if they had been a little overly exuberant back where you showed that peak there.
Right.
And so they were a little disappointed. So I also think they kind of overreacted. But even when I back down all my estimates, I still get it as a good thing to buy now. And I was just reading that even with all the healthcare stuff, no matter what happens with that, people feel like this electronicization, or if you want to call it whatever, of medical records is still going to happen because it is a good thing. There seem to be some things about the changes that are going on in the health business that people feel will keep in place no matter what the Supreme Court decides. They'll just stay in place because they're good things to be doing. And this one apparently has caught hold enough that people aren't really worried that it's going to get wiped out if the healthcare thing goes down the tube.
Yeah, and some of in my opinion, you're also seeing a maturity or a maturation, if that's a way to use the word, of a company that used to be in the 30s when it comes to an average PE, and now is literally coming to a point where, by the way, Value Line is a little bit exuberant at 27 here.
Yeah.
But for an average PE somewhere around 20, again, that's kind of like taking the edge off of the company. But that's just a natural PE compression as the company has grown. They've done a masterful job of capturing opportunity in the market that they serve, and it's a company that we've followed for probably over 10 years, first discovering it in the Forbes fastest growing companies list, probably around Halloween sometime 10 years ago. I know that many of the people in the audience probably directly own shares of this company. So
they have set themselves up, that they pretty strongly made the point that this last quarter was a one-time thing and a minor little just, timing problem. So if something happens this next quarter, that would probably be a big disappointment. But, from what they were saying, they don't expect that.
Yeah, the marketplace really does expect this company to perform. I mean, you can see here that's a fairly good long-term position. And at Manifest, we like to pay an awful lot of attention to the next couple of years, so I typically just go in, dive into the annual data, and add a couple of years. And the numbers from Value Line were $1.65 for earnings, $1.90 for earnings out in 2013, and it was $5.15 and $5.90. So again, just for a quick glimpse, and using the Value Line numbers, again, you're into I left out this one year, but you're basically looking at a situation where the company is obviously going to be slowing down. It's just naturally going to slow down a little bit, and probably come somewhere into the mid-teens. There's still nothing wrong. There's nothing wrong with that picture.
Oh, you know, Laura Scott is mentioning an update on Yahoo Finance. There is some like soap opera stuff going on right now at this company. I've been getting all their filings, and there's this guy Ahmad Hussein who's trying to take over the board, and apparently he owns about 16% of this company, and he's proposed a slate of directors for the board, and apparently he's a real rabble-rouser. And QSII yesterday just put out this whole rebuttal and listed the whole history of dealing with this guy, and he's been sued. They've had settlements with him that he's totally ignored, and he's rabble-rousing again and trying to put a bunch of people on the board at this company, and you know, QSII is fighting it. So there's a big soap opera going on with their board and with their voting for their annual meeting that's coming up apparently. But I couldn't figure out really, since it had been going on so long. I mean, this guy sounds like your typical jerk that you don't want on your team, but you're stuck with him.
Yeah.
But they've been dealing with him apparently for years. I mean, the problem is he owns like 16% of the shares, so he gets to be on the board. And
right.
So I couldn't tell whether it was something to worry about. Obviously, QSII is making a big push to get their stockholders to vote to make sure this guy's stuff doesn't go through, but you know, it's hard to know what the whole story is too.
Yeah, like I said, there's a fairly long thread in the manifest forum, so you can take a look at some dissenting type opinions. Again, I don't know how strong the dissent is, but here's a note from Joan Loken about the expectations for spending because of the health care reform. You can see here we're taking a look at, this is actually one of my posts showing the damage that had been done back a few weeks ago. There's a very familiar looking picture. So you can see there's a number of things here, and it has been a little bit disruptive. And then I suppose, did Laura mention where that information came from? If I go over to Seeking Alpha, might I find?
It actually was released in their financial filings.
Okay,
and Finance Yahoo has links to stories about it.
Okay, let me jump in.
Just go to the Yahoo Finance page.
Well, I'm going to be stubborn. I want to look at Seeking Alpha for now.
But it's actually really fascinating just to read. It was like a 14A filing. It was this whole soap opera of everything they've gone through with this guy over the years. It's their rebuttal filing to what he filed.
Okay, I'll go and check that now. There are some articles here that may give some input, but again, a number of us have actually looked at a number of these articles. You can see this is over a month old, and again, nobody has reported back anything really substantial. Here's the headlines, Lori. Would it be this preliminary proxy materials, or?
Well, yeah, I actually got the email from them that had the actual filing in it. I mean, if you went to the SEC site, you could find that it's totally readable.
I'll tell you what. Let's either you or I post that as an addition to the QSII forum post.
Okay, try that one that says files preliminary proxy materials. Maybe it has a text in there.
If we don't find it here, we'll actually add it to the forum. This looks like regular.
Oh no, this is it.
This is it.
This has the text from the filing in it.
Okay.
Does this have? Go scroll down and see if this has the whole history of dealing with this guy. Because a day or two ago they had this guy's initial filing. He had to file too when he nominated all these people. Yeah, here's the whole story of.
Okay.
It's like a whole soap opera. See, it says many times over the years Mr. Hussein has tried to take control of the board.
Okay.
So it's a big brouhaha going on with them, and that may be another reason that the market is a little bit playing it safe right now, is in case this guy really upsets the apple cart somehow. Who knows what he's upset about? But
well, I'll tell you. Here's my here's my instinct, and this is nothing more than Mark's gut. You know, and you may remember back to BioReference Labs around Thanksgiving. I mean, this company could still be lying to us. I realize that, but the numbers at BioReference Labs have always looked pretty good. Fundamentals are pretty strong, and it's been quite rewarding to hang on through all that turbulence. Same thing kind of feels. This one feels kind of the same. I mean, this is a very disruptive, dirty laundry type situation. I would encourage anybody here that to go ahead and find this first filing. Again, we got to this right by Finance Yahoo, right under their headlines, and it's in that first slot. So I'll put that link on the manifest forum, but you know, read it and jump to your own conclusions. But and certainly, if you discover anything that would be of substance or material to all of us, we'd certainly welcome hearing about it. But again, my instinct is it's just another one of those situations that I mean, from my perspective, I'd wait for another 4 or 5 Goldman Sachs downgrades and then be ready to jump in and buy the darn thing.
Yeah, I didn't see, looking at all their financial stuff and listening to their conference call, didn't seem like anything to be very freaked out about. It seemed like they were a pretty solid company.
And let me use this as an opportunity to show you where we are extracting that bullish or bearish trend. And here you see quality systems. If you go to stockcharts.com and you click on their point and figure option, again, you can go to the chart school and learn about this type of approach to taking a look at stocks. They basically have, I call this neutral. It's preliminary bearish, so it's neutral but trending bearish. And you can see they have this price objective of $26. So they're actually getting down pretty close to that. It closed at $26. So they're down here where you could have an inflection and turnaround. And as a long-term investor, this is kind of a cool place to be paying attention to the company. And if we come back to our portfolio, you're seeing basically a company that could be bullish. It is 4.8% of total assets. If the fundamentals are intact, as you see here, again, you've got a pretty decent situation. So a month from now, we could be talking about accumulating this company.
Yeah, actually, there's a couple comments. Mary Wrench mentioned that she had read that the deals that were expected to close in March closed in early April, which affected their earnings, which is exactly what happened.
Right. And
I think even at the point they were doing their conference call, they may have closed those. John Kimmel actually did make a motion that we buy 200 shares, and Butch Lang is asking whether Cerner would be the better choice of the two. Okay, that's one thing about QSII. They definitely have a lot of competition.
Okay, we can take a look at the side-by-side comparison as we talk through this. If we get a motion, we have a motion to buy another 200 shares of Quality Systems. Again, it is at 4.8. We could be a little bit early on this one, but we're willing to be a little bit early. It is down there towards bottoming out. It is in the sweet spot. Does anybody care to move or care to second the motion to accumulate an additional 200 shares of Quality Systems? And then while we wait for that, let's actually just go ahead and take a look at, I'll tell you what we can do.
Okay, it's been seconded by several people.
Okay.
Though Marty Ickerly says he'd rather move to buy 70 shares of FOSL.
All right, well, I think we'll have a little bit of money left over. Let me go ahead and jump into dashboards for those of you that may not be familiar with using the worksheet on our dashboards, because that's how we can do a side-by-side comparison with Cerner. Dashboards appears to be running a little bit slow. We must be updating some stuff in the background tonight that I didn't know about. Okay, here's the Challenge Club. I'm just going into the Challenge Club. I'm going to copy this particular dashboard to my worksheet and view it. And I'm going to add Cerner so we can take a look at them side by side. And I believe the ticker for Cerner is CERN. get it so that we have it on the dashboard. Anyhow, you can see Cerner. I think the basic story on Cerner, it is a very high quality company. It's in the exact same business as Quality Systems. The thing that I find with Cerner, and this is just Mark's opinion, I'm trying to explain what I've seen over the last several years, Cerner is the most recognizable name in that business. So when people figured out what was happening in the healthcare arena going back 6 to 8 years ago, Cerner was the company that a lot of the institutional investors ran to and jumped on the bandwagon very quickly. And the result of that is the stock price that jumped up pretty handsomely. And basically the projected return on Cerner reflects that is a bandwagon that has been in progress for quite some time. But there's absolutely no question it's an extremely powerfully good company. But when comparing the two side by side, they're pretty compatible or pretty comparable when it comes to the core fundamentals of both companies. Cerner's a little bit bigger, but again, that aggressive chasing or people jumping on the Cerner bandwagon has resulted in this depressed return forecast. So when you compare Quality Systems versus the two, again, pretty comparable side by side, except when it comes to the return forecast. Now, if we go ahead tonight and throw another 200 shares at QSII, we'll still have a. Why am I getting that?
You also get a dividend with QSII.
Don't know why. I must have punched the wrong key there. That would use up most of our cash for tonight, so Marty would have trouble with a motion on FOSL, at least at that point. We do expect to have a couple $1,000s in deposits for tonight. But again, there's the side-by-side, and just as a sanity double check, let's go ahead and jump over to Cerner, see what the value line forecasts do look like. And again, you see a number here that's fairly conservative, not quite so high at 3% for Cerner. And again, you can see that this company has basically zoomed. And again, I blame most of that on the institutional rhinos that needed to own a healthcare technology company, and this was the first target in their crosshairs. All right. Anybody else have any comments, or shall we call the question? Are there any other comments specific to the motion to add 200 shares of Cerner? Did we see anything, Lori?
Wait a second. Somebody's got their hand up.
I can help you look too.
Oh, maybe not.
Butch says that he likes the that we have a dividend here.
Yeah, it's actually 2.6% at the moment.
Yep. And it's been that way for a few years. Well, there is a poll there for a new holding too, Lori, that I stuck in there if you can grab that. And I'm going to come over I'm going to go into my other machine and sign in as Punksy Phil or something so that I get a vote.
No.
Let's sneak in the side door. All right, go ahead and we're talking about accumulating or adding 200 shares of Quality Systems, QSII. It will basically deplete our cash on hand. And your choices are buy or no thank you.
Oh, this is a real horse race. Whoa.
It's deservedly.
Yeah, this is a hard one.
Although I have to confess, although I'm not campaigning here, I don't think the buying opportunity is going to get much better. In other words, I don't really see Quality Systems, absent any earth-shattering news, getting much more attractive price-wise.
Yeah, I don't really put this in the same category with BioReference Labs at all.
I know, that one was a little bit, that one got under your skin a little bit. BioReference Labs, that is.
Yeah.
course, you get uncomfortable every time you find a major company doing something weird. You're destined to be a grumpy accountant.
Yeah, that's good.
Those guys are great.
Got me going on reading the Peekaboo Audit Revision standard today.
This one will be.
Those guys are great.
Let's go ahead and close it down in another 15 seconds or so. It's a split decision.
Yeah. Okay, I'm going to close it, and I will share the results. This one was neck and neck. That kept being one was ahead of the other, and they switched.
But even though it's a split decision, it looks like we've got a 56% in favor of buying. Not too many people present not voting, so we will go ahead and consider that a passed motion, which does basically deplete our stuff, or at least our cash reserves for the evening. We are at 923. Let's go ahead and check in with Marty. He was kind of the next in line. Does Marty have a microphone?
Well, Marty and Ebix has come up again, too.
Okay, we
started talking about
kick
that.
either one of those around. We were talking about Ebix in the green room, for those of you that weren't with us before the session started.
Yeah, Marty, I unmuted you.
Yeah, good evening, everybody.
How are you, Marty?
I'm fine. You put off a good story about FOSL last night, and even a week or so ago with another presentation from Ken, I believe, somewhere.
Yes.
FOSL would really fit well in the portfolio, I believe. It would be the only other holding similar would be Coach, I think. So, you know, it's too late now, but we might want to consider that next month if the pricing doesn't jump out of sight.
What is the story on FOSL? Since nobody's wearing watches anymore, I don't understand why.
Well,
I think they're in more than watches.
Yeah, they are. They're in apparel. They're in different kinds of things. In fact, I can probably give a condensed version of what we did last night, if that would be helpful, and basically tell everybody that you can go to our roundtable. I'll show you where to find it here in a second. But here was the presentation that we made last night on FOSL. Again, just to make the point that they are still selling quite a few watches, even though I didn't even wear a watch anymore, and this is a company that's been around for years. They also represent a number of other manufacturers, like Michael Kors sells through them, I know, I read, and there's a couple others that escape me right now off the top of my head, but they also do make apparel. They ended up at the top. The reason that they ended up at the roundtable session last night is they actually have the highest technical score that we give, and that's based on momentum and sentiment, and they have the highest fundamental rating at the top of the sweet spot when we did a search. They did have a massive price drop, approximately, well, within the last 45 days. So the stock price literally went from almost 140 down to almost 70. But right now, if you correct for the price on our value line sheet, the low total return forecast is 17. There's our tribute to Martina McBride and the market being a teenage daughter. Again, that's just a reference to this incredible price drop that the company had. Again, we've been unable to find anything that would substantiate that type of a price drop. And looking over the fundamentals of the company, it still looks pretty good. It's a bullish trend. There you see the visual analysis. There's no glaring signs of weakness that would be something that you could attribute or blame a sharp drop. So I would encourage everybody, as Marty has suggested, to keep our eye on FOSL for the next month. Decide what you think as to how it fits in the portfolio, and if it continues to be attractive, it could definitely be one that comes up a month from now.
Mark, why don't you just put it in the dashboard for a minute to see what else stacks up?
Okay. We come back to the dashboard and we add FOSL. And again, FOSL, and this is one of the reasons that we found it so attractive for the roundtable. Extremely high quality rating and projected return that's basically right on the edge of the sweet spot at a 20% level. So that's why it's as attractive to us as we thought.
It's got an awful good growth rate too.
Yeah, and it would boost the overall growth rate a tiny bit. Again, not an overly ambitious PE for a company like this. Again, not the type of company you necessarily have to fall in love with and hold forever, but it certainly could make sense to hold for some point in some period of time. So, and again, if you want to hear more of the play-by-play, you can actually go to, and I'll show you where to find that. It'll probably be up tomorrow, but if you click on events at Manifest Investing, and you click on recorded events, sometime within the next couple of days, it'll actually show up here, and you can actually look at either the YouTube or the recording of the session if you want to page through some of that stuff. Pretty sure that there's actually some discussion of it here in this session that we put together for the Houston chapter. Okay. Anybody else have any questions or comments?
A huge percentage of their business is still watches. I just don't get it with this company.
Yeah. Well, when I look around, I still see a lot of people wearing watches. Definitely something to pay some attention to. And not only that, there's futurists talking about how the watches and cell phones are all going to merge, and basically Star Trek will be here. So there's all kinds of stuff being built into some of these fancy watches.
This reminds me of RIM. When you were,
what's wrong with RIM?
Yeah, what is
it? Tremendous opportunity.
Take a trip into Kohl's and look at the watch counter. It's quite long.
Yeah, I understand where you're coming from, Lori, and it's definitely worth kicking around. Here is FOSL, and where I got some of those names: Armani, Burberry, DKNY. It's Donna Karen. Zodiac, I know, is fairly popular, and they don't mention here the other one, Michael Kors, but it was mentioned in the company's literature when we went over it last night. It's a good study. It's a good-looking company, as you saw in that last visual analysis. So, again, unless you think Lori's right and the watches are headed for the antique shelf, could be worth looking at. All right, let's go ahead. Does anybody have any closing comments or questions?
I think Ebix is another one some people wanted to look at.
Well, Ebix is one that could also be worth taking a closer look at a month from now. Again, taking a look at it on Value Line. It's not in the standard edition.
Mary Wrench also would like to look at Gentex. She has her hand up.
Gentex, okay. That's one that has come up and was actually selected by Ken for that Houston session. So Gentex is probably looking pretty good. Pretty good characteristics for Ebix. They did have a little bit of a stumble not too long ago. If you take a look at them on a longer-term price chart, this is Ebix. Will be coming up. You can see that we actually did own Ebix, and we discovered before the meeting that we actually sold somewhere back in here. So the company is actually down about 25% from where we sold it from this particular club portfolio. So it could be one that's worth a little bit of a closer look. And again, I would go to taking a look at how it stands on Manifest. What are the analyst expectations for the company? You can still see a decent growth rate, very profitable company, and we're talking about a sweet spot return and a good quality rating. So it definitely could be one that we take advantage of. When it comes to let me jump over to, it's actually kind of neutral now. It'd be kind of nice to catch it at one of these oversold opportunities like we saw here, back in the $17 to $18 range. If we could somehow engineer one of those in the future. It's a good-looking company. Let's look at Gentex. Gentex, as I recall from comments made by others, has taken a little bit of a swoon. There's been no real big swoon unless it's anticipating. It could be a leading indicator for the automotive industry, but It's actually come down from 30-something to about 20 over the period of the last 3 or 4 months. So it has come down quite a bit. It probably looks pretty good on our site. Could be another one to take a closer look at and watch carefully as a potential buying opportunity for a month from now. Does look pretty good. And by the way, if my dad's favorite stocks include Colgate and Walgreen, Gentex is right up there too, and he likes that one because that one's made positive returns along with Colgate. So if we put Gentex in the portfolio, we're forbidden from ever selling it. Good looking company, doing a lot of good stuff. So we can actually put some commentary on in the forum, and anybody who wishes to add to it, certainly welcome to do so. Type of stocks that could definitely come up a month from now. So with that, I'm showing 9:30. How are we doing on questions? Is there any other comments that people would want to take a look at? Or have we handled most of them, Lori?
But just wondering if you get concerned with the crossover of the 50-day and 200-day moving average, I guess, for Gentex.
Okay, we can take a quick look. You can see that a value line has a pretty favorable outlook, and they've actually come down a little bit since that point in time. Yeah, a little bit. Nothing major, I don't think. The real concern here is that the long-term trailing average has trended down finally, and some of this selling pressure is definitely the institutions running because of this crossover. It's definitely in kind of a bearish mode. Let's see what the trend looks like.
Mary Wrench says there's a reason the price change is because the National Safety Board changed the date the kind of mirrors required by law gets instituted. So I wonder if they delayed.
They must have delayed it, I would guess. Definitely, Mary, if you want to add that to the commentary on in the forum, we'd certainly welcome that. I wasn't familiar with that detail, but it is a little bit bearish again. Here you're looking at a price objective as low as 7 if the bottom were to fall out. So that's why some of the institutional traders are a bit skittish. Hope it doesn't go to 7. That could make my dad angry. All right, I think we'll go ahead and shut down if nobody's got any other things to bring up. I think pressing. Again, we thank everybody for attending. We'll go ahead and throw those 200 more shares of Quality Systems. Thank you for your participation. Continue to keep
Mary says we could buy more if it goes to 7.
That's true. But that still won't make Dad happy. Thanks everybody for your participation. We'll have a date out for a July meeting, probably closer to the middle of the month. So we'll probably be about 3 weeks out from the next meeting.